Swayam Prabha. Digital India. Educated India.
Good morning. So, after discussing about the security analysis, or in general what we can talk, how we can take the decision in the financial market, or from individual investor point of view, when we should buy and when we should sell. Then we can talk about the combination of the different assets, or whenever we take the investment position in the different market, whether we should invest in one individual asset or we should concentrate more on the combination of the different financial assets. So, that is the question always comes to our mind. So, if we want to invest in a different combination of the different financial assets, then why we will take that position in the market, and why the combination is required, and why this concept of the combination of the different assets and general what we call it the portfolio of the different financial assets are required. So, that is the question always comes to the mind of the individual investors. So, in this context, from this session onwards, we will talk about the how generally we do the portfolio management and what kind of different strategies are there through which the portfolio can be constructed, and as well as we can also talk about the different theories who deals with the construction of the optimal portfolio in the different market situations. So, today we will be talking about the introduction to portfolio management. So, here whenever we start with the introduction to portfolio management, some of the assumptions always we keep in the mind, that whenever we deal with the market, always the individual investor wants to maximize the return for a given level of the risk, or in other words, sometimes also we can see some of the investors can take also unlimited amount of the risk to maximize the return, but that kind of situation is very rare. Sometimes also what we can see that with a given amount of the return, they want to minimize the risk, or for example, if you want the 15% or 20% return. So, to get this 20% return, so what is the risk actually maximum risk I can take. So, that actually the investor from the beginning can also fix. So, that is why this is the basic background or basic assumption always we should take whenever we do the portfolio construction. The next thing is always we already in the beginning what I said, that the portfolio exactly includes all of your assets and the liabilities, because whenever we make the portfolio, basically whenever we see that the investors or any of the financial institution make their portfolio, they look into the liability side and as well as asset side. Why we look into the liability side? It is basically portfolio is nothing but a optimization concept. So, if you talk about the optimization concept, what generally we can see, there are certain limitations, there are certain constants whatever we have, and always the investor wants to minimize that constant to maximize the return. So, the constants can be any form, the constant can be in terms of the risk, the constant can be in terms of the financial position of the investor, or the constants also sometimes related to the market. So, taking into account all the constants, always the investor wants to maximize the return. That is why always we can say the portfolio analysis or the portfolio management process will always involves with both assets and liabilities of the assets of this particular investor. Then already what we said, that the relationship between the returns per assets and the portfolio in the portfolio is quite important, because already we see that the most basic objective of the investor is to maximize the return. So, sometimes another question arises, for example, we have different financial assets, let we have stocks, we have bonds, we have some of the fixed deposits, or we have let we can say any of the bank savings, or we have any kind of the time deposits in the banks and as well as post office. Also we have the mutual fund investments, and as well as also we can see there are other financial instruments which are available in the market. So, whenever we make the portfolio, for example, we say that if we get 10% return from one asset and 20% return from another asset and 5% return from another asset, then can we say that the return what we can get or the combination what we can make from these different assets, the combination is really only the aggregation of those assets, or is there any kind of process or is there any kind of method through which the aggregation can take place. The aggregation can take place only whenever we can form or we can hypothesize the different assets to a particular firm. So, but the thing is, whenever we see that different assets have different characteristics, different assets have different kind of properties, some assets are more liquid, some assets are less liquid, some assets are easily available, some assets are not available easily. So, in this context what we can see, or some of the assets are marketable, some of the assets are non marketable. So, looking into this perspective, it is very difficult to combine those assets to make the portfolio. The another objective also you can see, even if you concentrate one single asset, for example, somebody wanted to invest in only stocks. So, if there are 10,000 or 20,000 stocks are available in the market, so how many stocks he should take, or why this much stocks? And second question is, whenever they take the stock of let 20 or stock of let 30, then why this 30 stocks? And whenever I have 100 rupees or somebody has 100 rupees, then how that 100 rupees will be allocated within the 30 stocks? Whether this allocation will be on the basis of the risk involved in that particular asset, or it is on the basis of maybe the simply weightage or the equal weightage to all the 30 assets. So, these are the different questions comes to the mind of the investor. So, whenever we deal with all those fundamental or practical questions related to this portfolio, whenever we construct the portfolio in the market, all the relationships and all these characteristics basically talks about the management of the portfolio. So, here if you observe this fourth point, that a good portfolio is not simply a collection of individually good investments. So, why it is not only the collection of individually good investments? Because just now what we discussed about the different type of characteristics, different kind of objectives, different kind of properties of the different financial assets, then the combination, making this combination is quite difficult. So, how to make this combination? This is basically the important step of the portfolio management. So, that actually we will see further that how this combination takes place and what are those different theories basically talks about the different combination in the financial asset, or to make this financial portfolio in the market. So, then you observe that in the whenever we talk about the risk return of the different type of asset, because that actually we are using very frequently. What we can see that you observe that always whenever we make the portfolio or whenever we deal with any of the financial assets, the most important parameters basically what we always see, the important parameters are basically the risk and return. So, basically this risk is involved with the individual asset, return also always we calculate from an individual asset. So, if you observe that the risk what you are calculating from the individual asset, and if we have 20 assets, if we have 20 assets and we have to calculate this 20 assets risk and 20 assets return over the period of time to make our portfolio. But here what we have seen that how this risk is calculated, how the return is calculated for the individual asset, and how the risk and return is calculated for the portfolio which is consisting these 20 assets. So, this is the objective from the beginning we want to see. So, that is why what we have seen that for an individual asset, sum of the potential returns multiplied with the corresponding probability of returns, that actually give you the expected return of this particular asset. But for the portfolio of the assets, it is basically the weighted average of the expected returns of rates of return for the individual investments in the portfolio. What do you mean by the expected return? The question arises, what do you mean by the expected return? Why this expected word is coming into the picture? Because once we take the position in the market, whenever we take the position in the market, we do not know how much return we are going to actually get from that particular individual investment. Let you start investment with a stock X. If you start the investment with the stock X, so in this case what we have seen, there is a probability, there is let 50% probability the stock X can give you 20% return. There is a 50% probability the stock X can give you 20% return. There is another 40% probability the stock X can give you 15% return, or there is 5% probability stock X can give 10% return, and there is also another 5% probability stock X can give you 5% return. So, this probabilistic function depends on the other external factors. The other external factors in the sense what I refer may be the market condition, macroeconomic variables, which includes your inflation, GDP growth rate. It may also include the political factors, stability, political stability, or we can say the stability of the government or the international relation, etc. So, these factors will determine what is the probability of getting return from the individual stocks. So, on an average, if that particular investor wants to invest in the stock, the average return, expected return, what he is going to get from this 50%, 0.5 multiplied by 20%, then 0.4 multiplied by 15%, 0.5 multiplied by 10%, 0.05 multiplied by 5%. Plus, if you add all these, then maybe we can say the total or the average expected return from this individual stock in this particular period will be this much. So, this is basically what the concept of the expected return, what always we want to arrive or we want to get from an individual asset. But whenever we talk about the portfolio, the scenario will be little bit different. The scenario is, for example, we have 10 assets, 20 assets. So, out of the 100 rupees, what already I told you that out of the 100 rupees or 200 rupees, that how much money should be invested in stock 1, how much money should be invested in stock 2, and how much money should be invested in stock 3. These are the different problems or different weightage always we want to know. So, this is basically if you get the weightage and then you get the probability, then you get the return what you are expecting from that, then only the expected return of the portfolio can be calculated. You just see this. This is basically a computation of expected return for an individual risky investment, because already why it is risky investment, because we know that any of the assets which involves both risk and return, that we can call it a risky investment. Because of the different situation, what we have seen, because of the different situation, the probability, there is a 25% probability that the possible expected return will be 8%, and there is a 25% probability the return may be 10%. So, there is a 25% probability that return may be 12%, and there is 25% probability the return may be 14%. So, whenever we take this possible rate of return, what we are going to expect or what we can get it from this particular investment. So, if you get this multiplication of possible rate of return with this probability, then the expected return in each case can be calculated, then finally, your expected return from this particular risk investment will be 11%. So, this is basically the calculation of the individual return of one risky investment. But again you see, this is basically the portfolio. What is the portfolio? If you talk about this different type of portfolio, so here we have the portfolio of the risky assets. So, what generally we have seen that this is the risky assets, risky portfolio whatever we have. Let the percentage of portfolio we have is 20% here, the expected return what we are getting 10%, then finally, the expected portfolio return will be 2%. 0.2 multiplied by 0.1, that will give you the 0.02%. But if you see this percentage of portfolio weightage will be 30%, then expected security return will be 11%, then the portfolio will be 3.3%. So, finally, what we have arrived that 11.5%. So, here what we can see that your W represents the weightage, R represents the expected return of the return for the asset 1. So, this is the expected return from one asset, this is the expected return from another asset, this is the expected return from another asset, this is the expected return from the another asset. So, this return may be calculated from the different probabilistic function. Then once you have this, there is a probability of 10% return to get from this investment or individual investment, there is 11%, there is a expected return may be 11%, there is a probability that we can get from another investment. Then finally, if for example, this weightage should be equal to 100. So, let 20% we are investing in stock 1, 30% we are investing in stock 2, again this 30% we are investing in stock 3 and 20% we are investing in stock 4. In this context, what we can see that if your weightage multiply by your expected security return, that will give you the expected portfolio return from this particular individual asset. And finally, if you take the combination of all, let this particular security this particular portfolio has 4 assets, and finally, what we have arrived that the expected return from the portfolio will be 11.5%. So, that is all what generally these are 2 steps. What in the first step what we have to do, you calculate the expected return of the security using this probabilistic function. Then once you can calculate the expected return of the security, then you assign that weightage, and in the gradual process we will find out that how this weightage will be assigned and how the weightage can be calculated for the individual asset in a particular portfolio. But once you, if the weightage will be given to you in this case only for the calculation purpose, then what you can do, this weightage multiplied by the expected return, that will give you the expected portfolio return. Then finally, if you take the summation of these, then the expected return from the portfolio basically will be 11.5%. Then another thing, if you observe, this is basically this after discussing about the return of the individual's investment and as well as the return from the portfolio, then we should talk about the risk, how generally we can measure the risk and of this individual asset and as well as the risk of the individual portfolio. Here you just see how the risk can be measured. Hopefully, you must be knowing in various stages that there are various measures of the risk. but the easiest measures of the risk, basically if you talk about the measures of risk, the risk can be measured in various ways. What are the different type of risk, actually we are not talking about here, I hope already this has been discussed before. But the measures of risk, the popular measure is the variance, and another measure is the root of the variance, the square root of the variance, that basically is nothing but the standard deviation. So, standard deviation is very quite popular measure. We can also use the covariance or the sometimes also use the coefficient of variation. So, there are various measures which are available to measure the risk. So, how generally this particular measures are calculated for a particular market? So, if you can calculate this variance, covariance or coefficient of variation etcetera or the standard deviation of this particular asset, and from this particular assets we can measure the variance of the return of this portfolio. So, that is why the first basic objective of the investor is to know that whenever he is expecting that I am going to get 10% return, or there is a 50% chance or 50% probability that I am going to get 10% return from this investment, then in this process he should also know how much risk he is taking. That risk is nothing but that is the variability of that particular return. So, what is the chance or what is the variation, what is the probability of getting this return of 10%, that basically is also decided by the how much risk he is going to face if he wants to invest in that particular asset. So, that is why what already I told you that variance is a measure of the variation of possible rates of return. Variance is a measure of the variation of possible rate of return from the expected rate of return. So, what you are expecting that this much return you are going to get, and what is the possible return or actual return we are getting. So, that variation between these two basically shows you the variance of that particular stock or particular investment whenever we take the position in the market. So, that is why the variance is nothing but the RI represents the possible rate of return or actual rate of return from the stock minus how much return you are expecting using this probabilistic function, square of this difference into the probability, how much probability of the variation is there. So, that basically or probability of happening this RI or the return from this particular investment, that basically will give you the variance. How generally it will be measured, that we can see later, but already I told you the standard deviation is the square root of the variance. The standard deviation is the square root of the variance. You just see this calculation, how this variance and the standard deviation of the returns of an individual investment we can calculate. If you observe here that what generally we can see, if you observe here that this is your possible rate of return from this particular asset, this is the expected return what you are going to get using this probabilistic function. This is your difference between the actual return or the possible return minus the expected return, the square of this. This is the probability of getting this 11%, 11%. So, if you take this multiplication of RI or the possible return minus expected return, square of this possible return and expected return, then finally you can get this, and finally the total variance will be 0.0005. So, the variance of this particular individual asset with this probability of 25% chance of getting those returns, 25% chance is getting this return, 25% chance is getting this return, the 25% chance is getting this return etcetera. then finally what we can see that the variance will be 0.0005. Then obviously, the standard deviation will be the square of this, it will be 0.2236. So, this is basically the variance or the standard deviation calculation of an individual investment. Then later one, if you see this another concept, already I told you that covariance of the individual returns. So, how we can calculate the covariance of the returns, or what do you mean by the covariance? The covariance is basically nothing but it is a measure of the degree to which two variables move together relative to their individual mean values over time. If you minutely observe this, it is basically shows with respect to or relative to the individual mean values of that particular return of the particular stock, how these two stock move together or how the two assets move together. So, that basically is nothing but, or we can define that one is the covariance of the returns of this particular two assets. So, if you denote it in this way for two assets I and j, the covariance of rate of return is defined as the expected possible return minus expected return into expected return from one asset minus the expected return of the same asset into the expected return into the actual return of another asset minus the expected return of the another asset. If you take this expected function between these two, then finally, you can arrive the covariance of the returns. So, in our finance literature or particularly the portfolio management literature, we extensively use this concept of covariance and the correlation coefficient, which is widely used in various cases, and there is a relationship between this covariance and correlation. What covariance says? Covariance says how the two assets return move together with respect to their mean values. But what the correlation says? The correlation says what is the relationship between these two assets, whether the two assets are related or not. If the two assets are related, then why they are related and how they are related. How they are related in the sense whether they are positively related or they are negatively related. So, to know this correlation coefficient or correlation between the two assets, we have to use certain formula to find out this correlation. Hope you must have aware about this different formulas or different methods through which we can calculate the correlation coefficient. We have the Spearman correlation coefficient, we have the different type of correlation coefficient we generally calculate. So, basically the basic objective of the finance literature is to know what is the interpretation of correlation between these two assets. If the two assets correlation is negative, what does it mean? If the correlation coefficient between the two assets is positive, then what does it mean? So, that is the basic objective of the financial analyst, to know how these two stocks or two assets move. If they move in one direction, then definitely we can find a positive relationship, or if they are linearly related in a positive way, that means if we can say that the return between the two stocks or return between the two assets are linearly positively correlated, then what you can say that two stocks move in the same direction. So, that is why there is a relationship between the covariance and the correlation. So, what generally here sometimes instead of doing this in the literature, what generally finance literature, what generally we do, we always calculate the correlation coefficient by standardizing the covariance by the product of the individual standard deviations. That means, this is one of the ways through which the correlation coefficient can be calculated from the covariance term. So, what is the basic objective of doing this? The basic objective of doing this is that if the covariance will be known to you, that means which is basically nothing but how the two stocks move together, and with respect to their mean values, and basically if you know this risk involved in this particular two stocks, which is measured as standard deviation of one stock to standard multiplied by standard deviation of another stock, then we can come to know how these two stocks are related, whether they are positively related or they are negatively related. So, if you observe here, your Rij is nothing but the correlation coefficient of returns, and this one is the standard deviation of one asset, standard deviation of this particular returns, and this is the standard deviation of the return of another asset. So, if you have these two, then this has lot of implications or lot of use in the financial terms. How these two things will be used, that we will see later, but this is the way through which the relationship between the covariance and the correlation can be established. And what do we mean by this covariance and what do we mean by this correlation, that already we have discussed. That is why the correlation coefficient only in the range +1 to -1, already that we know, because a value of 1 would indicate the perfect positive correlation between the two assets. That means that the returns for the two assets move together in a completely linear manner, that already I told you, and a value of -1 would indicate perfect correlation. It means that this returns for the two assets have the same percentage movement, but in the opposite direction which we desire. That means, in general you just take the example in this case, you want to invest in the market, and if you have started the investment in the market, that what generally we do, we should take the position in the market in such a way that if we are losing in one stock, we should gain in another stock, or if we are losing in one asset, we should gain in another asset. So, how this particular compensatory, or we can say the compensating effect will work? This will work if there is no relationship, or we can say there is a perfect negative relationship between the two stocks. That means, if because of so and so factors, because of some external factors, if value of the one stock or the return for the one stock is going down, that means even if you are losing in the market, then if there is a negatively correlated stock we have in our kitty, then what will happen, that stock will definitely perform better in that particular time. So, if one stock is losing, another stock is gaining, then automatically the total risk or total loss what we are making in the market, that will be compensated. But if the two stocks are moving in the same direction or they are positively related, then what will happen, that if we are losing in one stock, definitely we will lose in another stock, or if we are gaining in one stock, then we are also gaining in another stock. So, to get this precautionary position, or to get a to take a precaution in the market, what generally the investors always do, the investor always trying to find out those stocks which are basically move in the opposite direction. If one stock value will incline, the one stock value will increase, then we should expect that the value of another stock should decline. So, there is an inclining trend of one stock and there is a declining trend in another stock. So, that basically will work as a compensatory effect in the market. Although it is in practice is difficult to find out the stocks or find out the different type of assets which are perfectly negatively correlated, but still as far as possible the investors always try to find out those stocks which are negatively correlated, or at least the correlation between those two stocks is very less. So, in this context what you can do, the return can be neutralized, or at least with a given amount of the risk we can maximize our return with other macroeconomic conditions. So, then if you observe that, coming back to this is basically what we talk about the individual assets or individual stocks or whatever individual financial assets which are available in the market. So, then coming back to your portfolio risk, what do you mean by this portfolio risk? It is basically what generally will happen, that for example, what we have seen, that you have two stocks, you have two stocks, select x 1 and x 2, and your return you are getting from x 1 is r 1 and return you are getting from x 2 is r 2, and the basically the variance, and this is the wattage you are given in x 1, this is the wattage you are given in x 2. So, what generally, how, if this data will be given to you, then how we can calculate, the risk of the portfolio of these two assets, or basically how generally we can calculate the variance of this portfolio or the standard deviation of the portfolio. So, in this case what generally we do, so how generally we measure this? The measurement of this risk or this portfolio is calculated as, or the risk of this particular portfolio is calculated as, the variance of the portfolio is nothing but it is the W 1 wattage what we are given for the first assets, W 1 square with the square of this, and the variance of R 1, which is the return what we are getting from stock 1, or the variability of return what we are getting, plus W 2 square and the variance of R 2, then plus 2 covariance your R 1 and R 2 and into W 1 and W 2. So, this is basically the variance of two assets portfolio, the variance of two assets portfolio. So, here generally what we do, we calculate the variance of R 1, we assign the weightage we have, whatever we have for the stock 1 or the investment 1, we calculate the variance of R 2, then also we decide what is the weightage we can give to the stock 2, then we have to calculate the covariance between R 1 and R 2, then finally, we have to calculate the variance of the portfolio. So, that is why what here I am trying to say, the variance of the individual stock or individual asset calculation is totally different from the variance calculation of the portfolio. So, here if you observe what we have taken, so this is that is why the standard deviation of this portfolio. W I generally represents the weights of the individual assets in the portfolio, where weights are determined by the proportion of value in the portfolio. Maybe there are other categories, but here if you can take also in this way. Then this is your variance rates of return for asset I, it is a generalized term whatever we have used, but if you have 3 assets, 4 assets, 5 assets, does not matter, automatically the different terms will go on increasing in your equation. Then the covariance between I and j within the two investments, it is the covariance between the rates of return for asset I and j, and here already we know that the covariance is nothing but it is your correlation coefficient between the I and j. I is one asset, j is another asset, and this is the standard deviation of I, this is the standard deviation of the j. So, this is the way through which the portfolio risk is calculated in the market. So, what we need whenever we calculate the portfolio risk, any asset of a portfolio may be described by the two characteristics. One is your expected return and the expected standard deviation of the returns, already what we have seen in the previous calculation, and the correlation measured by the covariance affects the portfolio standard deviation, that already we have seen from the previous slides, that how the covariance and the correlation are related. Then also we have seen that the low correlation reduces portfolio risk while not affecting the expected return. If you observe this third point, low correlation reduces portfolio risk while not affecting the expected return, because the correlation is not related to expected return from individual stock. Correlation is not related to the expected return from the individual stock. So, therefore, what happens that even if, because once the correlation will be negative between the two assets. So, here if you just expand this equation, the variance of P is your W 1 square, the variance of R 1 plus W 2 square, the variance of R 2, and you expand this covariance term, that is the 2, your correlation between between 1 and 2 and standard deviation of 1 into standard deviation of the 2 and W 1 into W 2. So, here what will happen if the R 1 2 will be negative. If R 1 2 will be negative, then what will happen? The term will be W 1 square, the variance R 1 plus W 2 square, the variance R 2 minus 2 minus 2. So, here this term will be minus, then R 1 2, the standard deviation 1 and standard deviation 2 and the W 1 and W 2. So, here in this case, once this term will be minus, then what will happen? That automatically the total variance of the portfolio will go down. And why it will go down? Because from the total this term we have to deduct this term. So, once we deduction will be there, we are subtracting this variance W 1 square variance R 1 plus W square variance R 2, then automatically the total variance or total risk of this is the risk of the portfolio will go down if the correlation between these two stocks are negative. So, that is why what we can see that the low correlation reduces the portfolio risk while not affecting the expected return. Anyway, it is not affecting anything to return part, it is only in this variance term whenever it is deducting or it is subtracting this term, then automatically the total portfolio variance will be reduced. So, if you observe this example, so what we can see, we are combining different stocks with different returns and risk to calculate your portfolio risk. So, what generally we have seen here, if you see your this is your assets and basically this is the expected return, this is the expected return, this is the weightage, sorry there is some misalignment. So, here if this is your expected return, this is your expected return, this is your weightage, this is your variance and this is basically the standard deviation. This is basically the 0.07 is the standard deviation, and for 2 asset 2 this is your expected return, this is your weightage, this is your variance and this is your standard deviation. The 0.1 is the standard deviation. So, here what generally we can see that if we take this case that whenever for stock 1 we are getting expected return of 10%, putting the weightage of 50%, variance is 0.0049 and the standard deviation is 0.07. For stock 2 the expected return is 20%, WI that means the weightage will be 50%, the variance will be 0.01 and the standard deviation is 0.10. So, there are various cases what we have taken, that case there are let we have taken 5 cases and the correlation coefficient between the two assets have been given. Let the coefficient of correlation is 1 between the two, that means they are highly positively correlated, and the covariance will be 0.007. Then the for case B, let the correlation coefficient between 1 and 2 will be 0.5, then the covariance will be 0.0035. For C, the correlation coefficient is 0, then automatically the covariance 0. These are different hypothetical situation what we have taken. Then for D, let the correlation coefficient is minus 0.5, and the covariance will be minus 0.0035, and for case E, the correlation coefficient is minus 1, the covariance will be minus 0.007. So, then if you add this, already we have said these things or we have discussed these things, that assets may differ in expected returns of return in individual standard deviation, but the negative correlation reduces the portfolio risk, what already we have seen here, and combining two assets with the minus 1 correlation reduces the portfolio standard deviation to 0 only when the individual standard deviations are equal. Individual standard deviations are equal. So, that sometimes a very hypothetical situation what we can say. So, here if you observe this thing, that there is a constant correlation between, there are different situations what we are talking about here. There is another situation here, if you observe, we have taken the constant correlation between the two assets, but the weightage we are changing. In the previous case what we did, the weightage was constant for the two assets, that means 50% we are investing in stock 1 and 50% we are investing in stock 2, but 50% we are investing in stock 1, asset 1 and 50% in stock 2, but what we have observed here, that the correlation coefficient is changing in the different situation, and once the correlation coefficient is changing, how the covariance is changing, or automatically the risk is also will be changing. So, that is why what generally we can do, we have seen this in the previous case, that the weightage were same, but the correlation coefficient was changing, but here we are talking about the constant correlation between the two assets, but on the case basis we are changing their weights. So, if you are changing their weights, then what we have observed here, that let your expected return from stock 1 is 10% and the expected return from stock 2 is 20% and the correlation coefficient between them let 0. If you talk about this, what generally we can see, that case 1, then automatically your let your W weightage in the first case will be 0, the weightage will be second case is 100%, then the expected return will be 20% obviously. Then the risk, what you can, using this formula what you can do, if you calculate the risk will be 10%, because how generally the risk is calculated, already I told you that this is basically W 1 square. W 1 square means W 1 square R 1 square plus W 2 square R 2 square plus 2 covariance R 1 R 2 W 1 W 2, and this term is expanded, W 1 square R 1 square plus W 2 square R 2 square plus 2 this R 1 2, the correlation coefficient between 1 and 2, standard deviation 1, standard deviation 2, W 1 W 2. If you put those values there, the W 1 is 0, the R 1 is your variance of R 1, this is the variance, and the variance of R 1 is already given 0. How much it is the. So, if you finally calculate this, you put these values in the previous cases, then in this way if you get the standard deviation of this series, then you will calculate the value will be 0.10 in the first case, and gradually whenever the weightage are changing, that means 20% to asset 1, 80% to asset 2, we are changing the expected return from the stock will be 18% and the risk you are facing is 8.12%. Like that, if you change the 40%, 60%, then your return will be, expected return will be 16 and the asset will be, and the total risk will be 6.62. So, and like that, if you take in the weightage of 50-50, the return will be 6.1%, return will be 15, risk will be 6.1, and like 80-20 you will find it is 12% expected return what we are getting, and this is 5.95, and this if it is weightage is 1 and 0, then we are getting 7%. So, basically what we have seen that the risk involved in this particular process basically depends on the different combination of the assets whatever we have. But here in the beginning what I said that the hypothetical weightage what we are giving to the different assets that basically talks about the or that basically decided the how much return we are going to get and how much risk we are going to get. So, the basic step of the portfolio management or the most important step of the portfolio management is to find out that how much weightage we should give to different assets. If you can decide this, there are various theories what in the other sessions we will talk about, but here already we have seen that this is the different step or this is the most important step basically always we should look into whenever we calculate the expected return and risk of that particular portfolio. Then if you plot this for the different weightage, then what you can see, this is your x axis represents your standard deviation, y axis represents your expected return from the stock. What we have seen that if you see this, if you assume that the correlation coefficient between them is highly positive let +1, then with two perfectly correlated assets, it is only possible to create a 2 asset portfolio with risk return along a line between either single asset. What does it mean? It means that if there is a perfect correlation between these two assets, then there is no point of having the two assets in your portfolio. So, if you have only one asset in your portfolio, so that basically will solve your purpose, because automatically you are not going to minimize the risk in the market whenever you invest these two stocks in this particular portfolio. That is why if you find that the correlation coefficient between the two assets are highly positive, or we can say it is close to 1 or it is exactly equal to 1, then there is no need to take into account these two assets in your portfolio. In one asset portfolio will be enough to give you your desired return. Then here the another situation, if you see, it is the with uncorrelated assets, it is possible to create a 2 asset portfolio with lower risk than either a single asset. Because if you go on, if you have the different assets in your portfolio, what we have seen, you will find a, if you go on increasing the standard deviation of the return, this is your, let you have taken the only single asset. So, this is your risk and this is your return, but whenever you take two assets in portfolio, let these are uncorrelated, then what you have seen that you are getting more with the same amount of the risk, your return has increased. So, that is why what generally we can say that if we have the assets which are uncorrelated or the correlation coefficient between those assets are not that much high, then we can minimize your return by investing in those assets. So, that is the thing generally what we are trying to say. So, like that if you, there are different combination also you can test with that how this changing the different assets or changing the different number of assets and changing these different weightage to the different assets with the varying this correlation coefficient will increase this value of the portfolio in the various period of time. So, here actually what we can conclude that we can say that whenever we make the portfolio, it is quite important to know that how much expected return we are going to get from this portfolio and how much assets we should have in this portfolio and how this particular different assets will be decided and which assets should be included, which assets should not be included, and how this different weightage should be given to different assets to make the portfolio. These are quite important aspects we should always look into whenever we decide the portfolio on our own. So, to decide this, there are various theories which have explained this in the different framework and different models. So, those models will be discussing in the future sessions, and as well as we should know that how this weightage is decided and what are those different parameters we should look into whenever we assign the weightage, and which are the different in philosophy, or we can say investment philosophy we should follow whenever we construct the portfolio into the market. And the basic thing is, if we talk about the return maximization for the investor is nothing but a utility maximization, then how this utility of the investor is maximized with a given amount of the risk, that actually we should see in the next class, starting with the theory of the optimal portfolio. Thank you.